Good morning and welcome, Patriot Radio News Hour. Joe and Jason live on this Wednesday, what is it? The 25th day of January. Yeah, we're wrapping it. It's almost over. Think about next Wednesday. It'll be February 1st. We'll have the latest installment of Fed rate hikes. A lot of, we said is earnings season getting into full force here. A lot of companies out. Microsoft was out. Hey, the number was good, but then they said, by the way, that's the last good number. First quarter estimates, very similar to 3M. Microsoft lowering guidance for 2023 substantially this morning. Boeing. I didn't see this one coming. Boeing posted a loss in the quarter. And again, right, supply chain issues, pricing issues, all that inflation that's supposed to be over. And then I got to look. Yeah, Serta Simmons, the giant mattress maker, filed for bankruptcy protection this morning. So bankruptcies, Jason, starting to slowly trickle in. Job cuts slowly trickling in. And then on these earnings this week, almost uniformity. There's a couple of exceptions, but most companies are lowering guidance. And of course, that means lower Wall Street. Wall Street right now down 400 points this morning. And Jeremy Grantham was out. He's one of these famed economists. He's saying, don't be surprised if S&P tests 3,200 or even lower this year, Jason.
Yeah, businesses that couldn't find people to hire last year are now firing people this year. I mean, it's one thing that if you can't find employment and employment's hard to find, and it goes to where, okay, we're staffed and we don't really need any more. But if you go from we can't find employees to now we're releasing employees, that's how fast things are moving a lot faster than it seems. It's just we're going from one extreme to the other, right, Joe?
Yeah, that's going to be interesting. And that's what you've heard all the tech companies say. Oh, we hired too many people, right? That's why we laid off. But now we're starting to get into these other companies like 3M. I forget who it was. Somebody else laid off 1,000 more workers again this morning. That maybe, hey, we weren't out hiring tens of thousands of people. They were hiring, but not to that extent. It's going to be interesting. And again, all kinds of claims. Goldman Sachs about housing. They highlighted several housing markets, Austin, Texas, San Diego, Phoenix, Arizona, saying get ready for a minimum of a 25% decline in prices. And Jason, we're waiting, right? We're sitting here. Things are moving quickly. They just appear to be slow because let's face it. With the 24 hours a day, 7 days a week news and the internet, you're used to things moving quickly. But this is quick when you think about. Yesterday we talked about the leading indicators, the biggest fall since the financial crisis. We talked about housing, right, in sales, and the biggest drop ever, right? I mean, these are things that they're happening, and they're happening pretty quickly. It just may not feel that way.
Well, and during the housing crash, the housing bubble, the great economic reset in 2008 timeframe, I remember the big day they showed was the 777 points the market went down, that one day. And I find it interesting where we're at here 2023, because we had this COVID emergency, and you can call it COVID's fault all you want, but there was an economic disaster coming. The repo markets were showing that big, huge banks weren't going to be able to get it done. And we had how many days, Joe, or even up days, but definitely a 2,000 point and 1,000 point down days, 1,500 point down days. But everybody was so worried about coronavirus, they just kind of ignored the massive, distress that was going on. I remember us reporting that stuff, and it just got swept under the carpet, Joe, like it never happened. I don't get how people don't talk about the great crash of 2020. All they talk about is coronavirus, right? So I look at that as like, man, we're feeling the repercussions of that crash now. They papered over it, so to speak, Joe, and then they come up with new emergencies to get us distracted. But it's here. There's nothing they can do about it, Joe. It's that inflation. They built that into the pie. They printed so much money in 2020 that here it is. And what are they going to do, Joe? They'll find some excuse or some finger to point at something, right?
And it's interesting because we forget, after the financial crisis, the crash that followed, all the programs that the central bank had unleashed all the way through 2011. But then, really, when you think about from 2008 all the way up till coronavirus, we couldn't get GDP above 2%. I mean, Donald Trump, I think he had a quarter or two where they got to 3%. Of course, they had to spend a bunch of money to do that, right? They had to spend a bunch of money to get the 3%. Then they unleashed that fire hose when coronavirus hit. Because remember, right, the Dow was taken, right? We were talking about the Dow maybe going back to 18,000. We had the temper tantrum in the bond markets. And Jason's right. They printed a lot of money to print over it. But think about it, even then, GDP growth, it wasn't awesome, right? You would think with the amount of money they printed, we should have GDP of 4, 5, 6%. And now, already the most, I guess, bullish forecast is saying we're going to have 0% in 2023. I think we'll be lucky if we achieve that. Not these earnings seasons, at least what they're telling us about guidance, it appears that way. (800-951-0592) Patriot Radio News Hour. Joe and Jason here on this Wednesday. You know what? There's three places I want to go today. Goldman Sachs has updated its housing forecast for 2023. Bank of America has updated its job creation / losses for 2023. And then an update on Social Security and Medicare, Medicaid are the three places. All of these three very big, important factors when looking at where we're headed for 2023. And then, of course, what's going to happen beyond 2023 in the biggest of the government entitlement programs, which are Social Security and Medicare. So let's start with Goldman. So Goldman said, hey, you know what? We got to revise our predictions for housing. They're now saying that they believe housing prices will fall in line with what we saw during the last housing crash. The last housing crash, according to Goldman, prices fell 27%. Jason, right now they think that prices for housing will fall 25%. And they said that the reflection on their views that rates are going to remain higher for longer. Goldman was in that camp that the Fed would be lowering rates sooner rather than later. They think that the lowering of rates may not happen till the end of 2023 or possibly 2024.
That's exactly what's going to happen. I agree with that. Almost spot on. They're going to stop raising the rates, whether it be one rate hike or two rate hikes, just like we've been talking, Joe. But sometime late this year and early next year, and this is all going to be predicated on how much market stress happens between now and then. I agree that there's always these cycles before a presidential election where they lower rates. There's so many times where you can't lower it if it's already zero. So when Barack Obama was running for re-election, there was nowhere to go there. But there's going to be election next year, and they seem to, whatever president can put the heat on the Fed or however you want to look at that situation, they will lower the rates next year, Joe, or late this year, whatever. But I think they're going to have a nice high rate, just like you just said from the report. And I think they'll just let it sit. All last year was raise rates, right? 2022 was the year of raising the rates. 2021 was ignoring the inflation. 2023 is going to be just stop raising the rates and just watch the destruction, Joe. Then once it gets to be severe, I think next year they lower the rates and try to get those markets up for the election.
Well, you know what? It'll be interesting to see. You know, they always try to tell, oh, we're not political. Yeah, okay. If you believe that, Janet Yellen, Ben Bernanke, Lael Brainerd, right? These are as liberal bankers as you could possibly get. I throw Jay Powell in that mix. They don't care. Look at, they got a balance sheet of $8.5 trillion, right? So don't tell me any different on that. But I'll say this: the Dow is not going to be 30,000 with a housing market down 25%. It's just not happening. I mean, and again, I think Jeremy Grantham's on the same boat. He's saying, hey, listen, at least another 20%. And he goes, and I think that's kind of like his baseline, 17%. But then he threw in the caveat, hey, it could even be worse than that. And he even mentioned S&P 2000. I mean, that's like 50%. These are really important things. When we talk about not having excess money in your bank accounts, Jason, this is what we're talking about. That's why, our sponsor, Why Refi, right? This is a way to get high rates of return up to 10.25%. How's it going to fall 25%? Yeah, you don't want to be in the stock market. Call our friends at Why Refi. And here's the best part. Housing can fall 5%, 10, 20, 30, 40. The Fed can keep hiking, stop hiking, cut, quantitative tightening, quantitative easing. None of it matters to them. Check it out. You got to have at least 50 grand. And here's the new part about this. You can use an existing IRA to get it done. So think about that, how easy that would be. And there is no, listen, you want to put $1 million with them, you can do that. I mean, think about it, $1 million, 10%, 10.25%. Hey, that's a nice return every year. Invest, yrefi.com. The word invest, the letter Y, REFY.com. Or you know the number. If you don't, write it down, 888-YREFI with a Y, YREFI with a Y, 24. And just tell them Joe and Jason sent you, because Bank of America, they've updated their jobs forecast. Now, I haven't seen this. Jason, we've been talking about jobs for months. We keep reiterating that, there's layoff announcements. They're picking up, but I'm not seeing these huge layoff numbers. Bank of America says this is going to change, and it is going to change very, very quickly. They're saying that December's non-farm payroll report, 223,000, is going to be a thing of the past. They expect non-farm payroll gains to turn negative in the first quarter. So, I mean, January's over. I mean, we got 1 week. January's over. The Fed's going to raise rates, we think now, 0.25 point on Wednesday. We're going to get that government jobs number, Jason, on Friday. But B of A is saying they're expecting before the end of the first quarter jobs to be negative 175,000 jobs a month.
Yeah, it's definitely coming, Joe. It's definitely coming. I mean, we were talking just a minute ago. How different would our conversations be on the radio right now if they didn't lower the rates in 2019 prior to COVID, and then didn't print any of that money? How many years of stress would have gone on between then and now, Joe? Right? I think we'd still be in the middle of it, right? And they're rigging this thing. They have, they're made, waving their magic wand, and they're deciding how it's going to go down, when it's going to go down, when it can go up. And I think they're going to try that magic trick late this year, early next year, just like the report you just read, by lowering the rates and printing sometime late this year, early 2024. The question will be, will it work this time? It worked in 2020, in a matter of a couple of calendar months. they went from complete disaster to complete recovery. I think they feel very comfortable in the fact that they can pull that off again, Joe. And that'll be the question. Will it happen that way again?
Yeah, and I hesitate here because when you start talking about these major banks, Goldman Sachs, B of A, guys like Jeremy Grantham, listen, we only get sanitized stuff. We're not on the call with Microsoft. We're not on the call with 3M, right? We're not on the calls with these banks and all these filings, right? We get the sanitized stuff that the news media puts out there. These guys are not operating in a vacuum, right? They're not making these predictions. They're not, I guess what I'm saying is they're not guessing what's going to happen. They've got a lot more information, and that's a huge turn of events when you're talking about negative job growth. And listen, their new premise is a harder landing than a softer one.
Joe, let me put it this way. This is an old trick. This isn't a new trick. This is an old trick. These big bankers, these aren't even central bankers. These are big bankers you're talking about. And they're talking gloom and doom. And they don't do this very often, Joe, but they'll do it once in a while. It's because I think they see beyond what they think is going to happen after a market crash. It's the same that the Rothschilds sent the fastest horses from the Battle of Waterloo. Napoleon was defeated, brought the news of Napoleon's defeat to England. And then what did they say? The Rothschilds walked around the business center, their heads hung down low. Oh, man, he won. Napoleon won. He's coming for us, right? And everything was sold. The entire market sold off. Everyone was running for the hills. And there was one buyer. It was the Rothschilds. And they essentially bought the entire country. Joe, if you're a big banker and you see a big crash followed by, hey, they're going to print like crazy like in 2020 and bring it all back, don't you want to buy that dip? Don't you want to be a big buyer on that situation? I think that's what they're seeing, Joe. I think they think there's going to be another big,
I'm
huge.
Tell you, I don't know. Can we afford another big debt bubble? Right? Is it possible? Have we hit that point where you've reached ridiculousness? That I think that's the biggest problem. The realities are the Fed is about done. Inflation is not done. I think we're going to this 2% thing is going to be. I think we're going to hear the Fed talk less and less and less about 2% and hope we forget, right? And we're going to be living in a new environment, that 3-4% inflation environment. This is going to be a difficult period for stocks, without a doubt. I think all of the whole debt market. I mean, we've got trouble in Japan and their markets. We saw what happened in the UK. Even what was it? Was it Switzerland? Even had a problem. They're all of these dams, Jason. They're all starting to crack. They're all starting to leak. The question is, which one's going to blow up first?
Right. Well, and think about what they want. They want the country to look like it's doing better for the news cycle, and then enrich their buddies. For those years after the crash, Joe, you had the 1% GDP and the 2% inflation. So if you have the 4% inflation, maybe you get the 2 and 3% GDP in the future, right? After the next chaos is going to happen. I really think that's where they're going, Joe. They want the higher inflation because they know that will show a higher GDP, even though it's false, it's fake. Obama said it was the economic recovery for 8 years. And what was it? It was sideways. And you had 2% inflation, which was killing the 1% GDP.
I've got a little difference. I like your analysis. That makes sense, right? That would add up. I disagree. I think with the higher inflation, we're still stuck at that below 2% growth. That's because the debt's overwhelming. I mean, it really is overwhelming. At what time? I mean, come on. The Fed's balance sheet's still $8.5 trillion, and they're already talking nonsense about, well, maybe we can start lowering rates and still sell off the markets, Jason. That's nonsense. It's nonsensical. And everybody on Wall Street doesn't believe them. This is the sad part. They don't believe them. When the Fed says rates higher for longer, when the Fed say, no, we're going to keep quantitative tightening, Wall Street doesn't believe it. They're like, nah, the second we start crashing this thing, you guys are going to tuck tail and run and do all this money printing. I'm not so sure. I don't know that they can get away, because what happens? You start printing the money and inflation goes back to 7, 8, 10%. Jason, I don't see it. I see higher inflation with no economic growth. It's going to be a brutal 10 years.
I agree with the time frame, and I still think that a little bit of a bullwhip, Joe, where we see positive GDP followed by negative GDP, then maybe positive. I don't know about quarter by quarter, but every couple of quarters you might see a very, very turbulent storm in the ocean, so to speak, where the boat's going up and down on those waves. That's what I see happening. I mean, it might be almost a year-by-year case, Joe. I mean, look at it. I mean, you have huge high gains in the stock market after it crashed and burned all in a couple of months in 2020. I think those kinds of things can continue to happen as long as people want to keep spending dollars. That's the thing. Once the dollars stop being spent worldwide, then they'll have nowhere to go. And they have a few more rabbits in their hat, that Joe, I guess, is what I'm saying. If they can get people to spend dollars in other countries, they can keep going with this. They
got a lot of names for debt, don't they? Right? Yeah. Now they'll come up and they call them tools in the tool belt. They're not tools. It's the same. It's just debt. We'll just call it something else. Quantitative easy. It's debt, right? Come on. Patriot Radio News Hour. Joe and Jason. We're going to switch gears and talk Social Security and Medicare next. 800-951-0592. Patriot Radio News Hour. Joe and Jason on this Wednesday. Remember, we get jobless claims tomorrow. Does B of A know something that we don't? Jobless claims have been really, let's call it fantastic. Granted, heavily seasonally adjusted, but B of A upping its job loss forecast. U.S. $10 liberties, man, they have been hard to come by. As the price of gold rises, more and more people switching to that half ounce because they can't afford that full ounce. But I've got U.S. $10 liberties today, 1,150 on a $10 liberty at 800-951-0592. And I'm chasing some silver. I'll let you know, hopefully in the next segment. I may have something there as well. But Jason, I wanted to switch gears and start talking about Social Security and Medicare. So the Government Accountability Office, the Social Security Trust Fund, saying Social Security is going to be out of money. It's already out. So I guess we can stop lying about it, but out of money in the fake trust fund in 2033. The problem is, and how Social Security works and Medicare, it's all one big pot for the government. And so when one fund starts to run out, they'll shift a little money from another fund that has a longer time before it's out of money. I'll use the Social Security Disability Trust Fund. Remember after the crash last time, this is interesting because it seems like more of these big banks are forecasting a big crash. We had a huge increase in the amount of people filing for Social Security disability. And so that fund ran out of money. So they shifted some of the Social Security money into the disability account to make up for that shortfall. So, well, it sounds great. Not that it's great because, it's 2023 and 2033. That's only 10 years, right? So we're out of time. I'm 52. The retirement age for me now is 70, right? Well, that math doesn't work, right? That math doesn't add up. Jason, he's only in his 40s, so he's got the math's even worse for him. But here's the problem, guys. That's not the fund that runs out first. No, Medicare and Medicaid run out first. And they are going right now. It's projected that they will run out of money in 2028. And I will tell you, they will not make 2028. That number is not a real number. And here's the problem, Jason: 65 million, I want to say, on Social Security, 59 million are on Medicaid. So, the two programs are almost equal in size. And so what's going to most likely is going to happen is they're going to have to shift money from the Social Security side to try to make up for the Medicare shortfall. Jason, we're not making it to 2030 at all. I said worst case scenario, Medicaid could be in trouble as early as 2025. It'll depend. A big recession would have to come.
Yeah, it depends on how they fund these things, Joe. It's always, sometimes money just sort of sneaks in there from some undisclosed location. But I agree with you on the running out. And one thing I like to tell the audience when it runs out, it's not that it really runs out. I mean, there's still the tax revenue comes in every month. What I foresee happening, Joe, I've said this many times over the years, is when Social Security runs out of money, like Joe's saying, they're not going to just stop paying benefits. That's not going to happen. But great measures will have to be taken unless they're just going to print more money and just throw it in there. And what they'll do, Joe, in my mind, is they'll take the very bottom earners of Social Security and they'll give them a raise every month. And then they'll take the middle and high earners of Social Security. It's like, look, it's out of money. There's nothing we can do. We can only pay so much. And instead of just taking it from, taking everything from some people, we're just going to lower you guys down. And they'll lower the higher earners and just, this is how socialism works, Joe. Give everyone the same bite, right?
Well, so just so people understand, Alan Greenspan during the Reagan years convinced everybody, let's cut all business taxes. Isn't that great? We're going to cut all their taxes. Oh, by the way, and we're going to let them get rid of pensions. But don't worry, we're going to give you that 401k. And by the way, we're going to overtax you for Social Security, right? The Social Security Trust Fund. Well, they spent it, right? That was the problem. There really is no trust fund. There's a filing cabinet, probably, I don't know, whether it's in D.C. or Maryland or Virginia, wherever the exact location of the filing cabinet, stuffed with a bunch of IOUs. It's like Dumb and Dumber, right? They had the briefcase with the $1 million in it. They just stuck a bunch of IOUs in it. That's what it is. So now, already today, fast forward to today, we already are putting out more than what's coming in. So the payroll tax that we're all paying, right? We're spending more than what's coming in, but they're pretending to spend down that trust fund, that surplus. To Jason's point, they could do nothing. Listen, all that happens is all that money gets added onto the debt. I mean, that's really all that essentially happens. I mean, they're making this deal like, hey, and whether it's 2033, 2028, 2025, whatever it is, all that's going to happen is, hey, we're going to use this opportunity to charge you more, right? They're either going to raise payroll taxes and probably a combination. We're going to raise payroll taxes. We're going to cut benefits for people. Oh, by the way, you're going to have to pay at a certain point. I don't even know what the number is now. Maybe like 150,000. After 150,000, you don't have to pay the payroll tax anymore. They can raise that number, right? They can do a lot of things to make it better. But essentially, Jason, what they're telling you is the national debt's going to really start skyrocketing when this thing is every year it runs out of money. Like last year, it cost the national debt about $60 billion. Well, the problem is this year it's going to cost the national debt $250 billion. Next year it's going to cost, $500 billion, and eventually they'll be out of money.
Yeah, I mean, you look at the U.S. debt clock, Joe. It just keeps on spinning and it keeps on going up, and that's what a banker likes, because debt enriches them. Somebody's getting something out of this, Joe. It's not like it's going nowhere, right? Somebody's getting it, and it's not going to get better, Joe. It's going to be lower standard of living, which has been happening ever since World War II ended. We had a high standard of living, didn't we, Joe, for a while, and it's just been grinding slowly downward.
800-951-0592. I got a couple lines open. $10 liberties. I don't even know the last time we ran a $10 liberty. I don't know if we've ran a $10 liberty this year yet. And where January's almost over. $1,150. I'm working on silver. I'm hoping, fingers crossed, I may have something before the end of the show here. Gold has come all the way back. Right now is dead flat, 1935.40. Silver's up 10 cents at 23.85. The Dow is down 300 points. Boeing, Microsoft, amongst others, saying that, Jason, things are going to get tougher, and we're talking about, the next 10 years. And we talked about what Goldman updating its housing forecast. We talked about Bank of America updating where they think stocks are going to be. Then we started talking about Social Security and Medicare. Listen. All the pension problems are back. California, Illinois, even South Carolina, New Jersey, they're all back. Everyone's talking about taxing the wealthy, Jason. And right now it's kind of hard, right? The wealthy are starting to lose ground. At the same time, all these states and all these social programs, they all need money.
That's right, Joe. They stopped printing money. I mean, you look, the Fed their balance sheet has come down. They stopped, at least as far as their balance sheet, they're not increasing it. They're not printing tons of money from what we can see up front with their information. And it's a cocaine habit that this country and the world has with printing fiat, fake, empty currency that has no value. That's what they feed on. They feed on this fake money. And so that when you don't print it, everything Joe's been bringing to you every single day about, hey, the more job losses are coming and companies are having stress and they can't get things done. Their sales aren't up. All the things that we've been talking about day after day is materializing towards a recession or something worse. And it's because, well, the free gift is not quite as free as it was, Joe. So, we'll just see, like I said, later this year or early next year, if they start giving away that free money again to try to stop the damage that's getting ready to happen, Joe, because I think they have to. They think they have to let this market crash and burn a little bit because there's nowhere else for them to go. They have to let it burn up a little bit. They have to get rid of some of that baggage. There's too much water in the boat, so to speak, Joe. They have to get the buckets out and empty the boat out so they don't sink, right?
Yeah, and again, we're watching. I just was getting handed a note on some silver here. We'll get to it in the next segment. I just think this is going to be a very difficult period. They've got to do something with the debt. The digital currency is coming everywhere. Today, Saudi Arabia making a big announcement about digital currency. I mean, it's a fact. This is where it is. The rules that they put into Dodd-Frank are coming. They put them there for a reason. Listen, they wrote Dodd-Frank the way they wrote it for a reason. They didn't fix too big to fail. How do I know they didn't fix too big to fail? Well, pretty simple answer. They actually made them bigger. They were already too big, and then your solution was, let's make them bigger. Since Dodd-Frank, what have we lost? Another 4,000 banks since Dodd-Frank? Right? All these little banks get gobbled up and gobbled up and gobbled up and gobbled up because they know, listen, at the end of the day, that these people with all the big money in those bank accounts, they're the ones that are going to pay, Jason. It's just that simple. And I lost Jason there. So we'll just keep working here as we look at all of these things that are happening, right? When you talk about, hey, the banks have set us up. They wrote the laws to say,
I don't know. I can't hear
You're
Joe.
going to pay for it. This is going to be a bail-in. We don't have the FDIC.
I can hear him now. Now I can hear him again.
They raised the limit to $250,000.
Is he good on your end?
But they wanted you to feel good.
Okay, bye.
You know what they wanted you to do? They wanted to sucker you. Hey, go ahead and keep $250,000 in the bank. That's fine. Matter of fact, you know what their favorite customers are? Hey, I'm smart enough. I don't go over the $250,000 limit, but I have 250,000 in 3 or 4 different banks. They love that. Thank you. Great. Because guess what? We're going to take it all. Don't worry. We're not going to tell you, we're not going to say we're going to take it. We're just going to borrow it because the FDIC doesn't have the money. And Jason, you start thinking about what B of A said today, what Goldman Sachs had to say today. We're starting to see bankruptcies trickle in. We know we've got a problem in subprime auto. Goldman Sachs says we've got a problem in those credit cards. Jason, this is another disaster waiting to happen. And now Goldman Sachs says housing is going to fall another 25%. We know what happened the last time that happened.
I still think, Joe, that the big banks wouldn't be talking this.
There you go. You got it. You're back. You're back. You're good. You're good.
Yeah, I don't think the big banks would be talking like this, Joe, unless they know what's going to happen after. Because if you want the markets to be good and you want the business to move in upward, you want the GDP to go up, you don't talk about how bad everything is. I think, Joe, the fact that these big banks are talking about how bad it is they know it's coming, and I think they want it to happen hard. I think they want to scoop up cheap assets. I think they think it's going to bounce right back up like in 2020. You said, what information do they have? I think that's the information they have. I think we have a little bit of a bullwhip happening. I think it's going to keep happening for several years, ups and downs. And if you know where it's going to go, Joe, you can become very, very rich off of this.
Look at what all these central banks are doing. You're talking about it looks like we're going to break the record set in 1967 for the record amount of gold being bought by central banks. And it's really simple. They're going to protect their losses on that fiat currency, and they're going to protect it with gold. That's what you need to be doing. Patriot Radio News Hour. We'll be back after the break. 800-951-0592. Jason, just like that, in between the breaks, gold's up 3, 1938. Make it 4, 1939. Silver's up 15 cents, 23.90. U.S. $10 liberties, 11.50. I'm getting more and more confident we are going to see a 1/4 point. We're going to see the Fed start talking about ending and potentially they'll keep the higher for longer, but rate hikes coming to an end. Higher gold and silver prices are coming. We told you weeks ago, if you want to pay more, just wait, because that's what's going to happen. But Jason, I just got this in. So I got $10 liberties, $1,150 a piece. Silver Eagles. Earlier, what was it? I think Monday we ran those sealed cases of 2016s. I don't have sealed cases, but these are going to be all back date years, and they're going to be good. They're not going to be all toned up and all. They're going to be crisp. They're going to look nice. $680 a roll. We were the cheapest around at $720. $680 a roll. That's $17,000 for the case. Jason, you could get anything. You can get 2022s, 2020s, 2016s, 2015s. And it seems like all of our competitors, they want to jack up the prices on all the backdated stuff. Not here at Patriot. Rolls of Silver Eagles at $680. Buy it by the case at $17,000. And then, of course, the $10 liberties, the first time this year on $10 liberties on special, $1,150 at 800-951-0592. And Jason, it's not on accident that you're talking about central banks around the world buying more than they bought in 1967 when they bought over, 640 metric tons of gold. And it looks like when the numbers come out this year, we're going to break that record. That just tells you, they already know. They know a lot of this fiat money, Jason, is going to come undone, and there's going to be a lot of pain to come. And they're buying that gold to offset the losses that they're going to see in the fiat money. It's just that simple.
Yeah, it has the feel for sure, Joe, that we are having a convergence right now of 2007, right before it got really bad, when the job losses came in. It kind of feels like we're in 2007 merged with the 1970s inflation. Doesn't that feel like what we got going on? We got both those happening right now at the same time.
What a great analogy. Remember in August of 2007, the Fed's funds rate was 5.25%. And Ben Bernanke was talking about a little froth in housing, and they're getting ready to raise rates again at the next meeting. And then, of course, we didn't even make it to the end of the year, and Lehman came undone. The spring of 2008, Bear Stearns came undone. That's a really kind of a good analogy of where we're at right now. The banks are screaming something's going on, and the Fed is like, nope, we're still raising rates. We're still taking away the money supply. I think it's setting up for something just like that to happen again.
And in 2007, 2008, they didn't have the inflation we have.
I know.
So, I mean, you got to add that on.
Man. 800-951-0592. You know what's funny? That's why all those central banks didn't break the record for gold purchases back then. That's why they're breaking it now. Make sure you're your own central bank. 800-951-0592. Jason and I were coming right back with the half-empty cup.